We're ready to get started. Okay, good afternoon, everyone. Thank you all for coming. My name is Steve Dewey. I'm the director of the Washington, D.C. chapter of the Bastiat Society. The Bastiat Society is a public outreach program of the American Institute for Economic Research, otherwise known as AIER. The purpose of the Bastiat Society is to educate and promote the ideals of free market economics and sound money, property rights, personal liberty, and limited government. If you'd like to learn more about AIER and the Bastiat Society, our website address is aier.org. Today I'm very honored and excited to have two outstanding experts on the Federal Reserve and the banking sector as our featured speakers, Tom Hoenig and Thomas Hogan. They will be speaking on the topic of the Federal Reserve and banking regulation and how the Fed and the banking sector can be improved with less regulatory indiscretion and overreach, less political influence, and better focus on the markets. A brief summary of our speakers' backgrounds. Thomas Hoenig's resume speaks for itself. He worked for most of his career at the Federal Reserve Bank of Kansas City, where he served as its president for 20 years from 1991 to 2011. During that time period, he was also a member of the Federal Reserve's Open Market Committee. After leaving the Federal Reserve, he served as vice chairman of the Federal Deposit Insurance Corporation for 6 years from 2012 to 2018. Since 2019, he's been a distinguished senior fellow at the Mercatus Center at George Mason University. He has been a frequent guest on TV networks, including CNBC and the Fox Business Network. Originally from Iowa, Mr. Hoenig earned his doctorate in economics from Iowa State University. Thomas Hogan is a senior research fellow for our sponsor, the American Institute for Economic Research, or AIER, where he engages in research and commentary on Federal Reserve policy, money and banking, and other economic-related policy issues. He formerly served as the chief economist for the U.S. Senate Committee on Banking, Housing, and Urban Affairs. He has also served as a research fellow at Rice University's Baker Institute for Public Policy and as a scholar at the Cato Institute's Center for Monetary and Financial Alternatives. Earlier in his career, he was an economics professor at West Texas A&M University and also worked for Merrill Lynch's Commodity Trading Group and as a consultant for the World Bank. He has been a guest on several media outlets, including BBC World News and Bloomberg, and has been quoted by several news outlets such as CNN Business, American Banker, and National Review. Thomas Hogan earned his doctorate in economics from George Mason University and his bachelor's and master's degrees in business administration from the University of Texas at Austin. So we'll now get started with their talks. Each speaker will speak for about 25 minutes for a total of about 50 minutes. And then after they are finished with their presentations, we'll go to a Q&A. So we should have enough time for a few questions from our attendees. So now we'll get our discussion started. We'll start first with Tom Hoenig, followed by Thomas Hogan. So Mr. Hoenig, the floor is yours.
Thank you. Thank you very much.
Okay.
Well, good. Whoops. Let me get myself organized. Thank you. Yep. Anyway, first of all, thank you, Steve, for the introduction. It's good to be on the panel again with Tom Hogan. He and I have done one of these before, and I always enjoy it. And I do look forward to the questions as much as I do speaking to you. I'm going to talk about capital, and I put this in there as, much expense, little return, and that's because I think the capital system for the banking industry is badly broken, has led to some very serious distortions and contributed to crisis. And I'm going to talk about that, and then Steve asked me to also speak a little bit about a paper I did on some of the issues around the discretion of the Federal Reserve. And I'll do that within the time frame, I hope, and leave plenty of time for questions for both Toms. First of all, I start out by just saying point blank that, the market no longer determines the capital standards for the commercial banking industry. It is done by the banking regulators and the lobbyists who can influence the regulators in the definition and the administration of capital within the banking industry. And that has really led to some bad outcomes. I want to start, first of all, by, in a sense, level setting. I look at capital as equity for purposes of my comments on the amount of capital that's needed in the banking industry. And equity is not a reserve, as it is so often misdefined. Capital is a source of funds to the banking industry, just like deposits, like other forms of debt. It is deployed, it earns a return, and it also provides much more discipline if it is used properly. And I think that's exactly what we don't do. I would tell you that because of the process, the regulatory process, there are two forms of capital now in terms of measurement of capital around equity. So we have the risk-weighted capital system, which is defined as Tier 1 capital, which is mostly equity, to risk-weighted assets. And therein lies I would say, the basic problem of that measure. It assumes that you can judge the adequacy of capital based on the regulator's assignment of risk to the assets that will be funded by both equity capital and debt, deposits, and other kinds of debt. That risk-weighted capital measure terribly distorts the system. For what it does is it has the regulator, through a process, define how much an asset should be accounted for on the balance sheet of the bank. So a loan would be effectively a weight of 1, whereas governments would be effectively a weight of, say, 10%. And then there's a whole range between that. But it assumes that, for example, CDOs, which are securitized assets, or CLOs, which are collateralized loan obligation, which are a securitized asset, is less risky than a loan, even though it is a securitized group of loans. But because you've securitized them and given them a greater mix of loans, it is safer than a loan directly. Well, that may make sense unless you're securitizing the same kinds of loans, concentrating the risk in this, and then providing a very low weight, like 30 or 40% to that, which then effectively reduces the size of the balance sheet. So when you do that, you get a capital to asset measure that is much higher than you otherwise would. And I'll come back to that in a minute. For example, if the risk-weighted assets on the balance sheet are half of what the book value is, and you have a certain amount of equity, your capital to risk-weighted asset is twice as large. And that's what you have going on here. And the other thing that happens is once those risks are set, they don't change. So sovereign debt, Greek debt, for example, gets in the earlier period the same weight as a U.S. government security. And so you get all these distortions. And the thing about, for example, government securities, if you will stay with me here, you have very low weight. So a bank can lever up on those without using its own investors' capital, because there is no required capital against it, or a very small amount. That's exactly what happened with Silicon Valley. Silicon Valley Bank failed, and yet more than half of its assets were in U.S. governments or mortgage-backed securities guaranteed by the U.S. government. There was no capital investor money required to fund that because it was such a low risk. So they levered up. And so they reported a risk-weighted capital measure of almost 15%. And they had a leverage ratio, which I'll come back to in a moment, of a third of that. So when interest rates went up and the value of those securities went down, there was no investor funding behind that. And therefore, they lost a lot of money. And when they said we were going to raise capital, people panicked, of course, because there was no capital there. So that's the distortions you get. In contrast, the leverage ratio, which is an imperfect measure, but less imperfect than the risk-weighted capital measure, is straightforward. It says, how much equity do I have against my total assets, book value at least, assets? So if I have a 5% leverage ratio, it means I can lose 5% of my assets before I go insolvent, before I wipe out my investor group. That's a very important distinction because that's exactly what Silicon Valley had, was about 5% capital against its total assets. So when the interest rates went up and the market value of the securities went down, there was no capital to absorb that loss. There was no investor funds to absorb that loss, and it went broke. Even though the other 40% of it, or 50% of its assets, if you will, were fairly well underwritten loans, but you were taking all these losses in your risk-free assets, you weren't able to survive. And therein lies the fundamental problem. Now, one of the interesting things about all this is, for the first time in my professional career, I think, Jamie and Diamond and I agreed on one thing. The risk-weighted capital measure, called the risk-weighted endgame, terrible idea. The risk-weighted capital measures involves thousands of pages of work, thousands of pages of rules. It takes an entire division at the FDIC to manage the risk-weighted capital system because it changes and they have to have their very arcane equations to measure probable future loss and so forth. And they can't answer the question, how much can a bank afford to lose of its investors' money before it goes insolvent? It doesn't answer that question. Because if you ask someone what's the risk, if you have a risk-weighted asset measure of 14%, that's a measure of what? Of what? Risk-weighted assets, but what are risk-weighted assets? Something the bureaucracy defined for you. So it's a very, very expensive, low-return program to provide safety to the banking and financial industry. In the great financial crisis, the risk-weighted asset measure, capital measure, said something like 11%. The leverage ratio was around 3%. Losses in the industry over that period were around 6%. So you wonder why we had a crisis. If today you were to actually require banks to recognize their losses in their securities portfolio, you would have a much more fragile banking system to recognize. I'll give you one example. Bank of America has about $230 billion of equity. If you took their hold-to-maturity assets and their available for sale assets, and you wrote them down to current market, they would lose half of their capital in one stroke. There's probably over 100 banks that under a writing down to book their government securities would be insolvent. But because they're not required to write them down and because we use a risk-weighted system, they report risk-weighted capital measures of 10, 11%. And so when you see it written, oh, they have gold-plated capital, it means they have gold-plated phony capital. because the industry is far less well capitalized. And I'll give you a couple of history of it, if I can. Oops. Oops, I'm going the wrong way. Oops, sorry. Can we back? Maybe I've, nope. Sorry, I went too fast. I'm wasting time. Thank you. Here is a graph of the leverage ratio for the banking industry from the mid-19th century, when the control of the currency was formed to provide a federal banking charter. And the way they did that is it was deposits were backstopped by government debt because of the Civil War. But because it had a federal backstop to it, the amount of capital required over that period has systematically declined. And when the Federal Reserve was introduced in 1913, 1914, it fell further. And then the FDIC was introduced, fell further, because the moral hazard problem grew. Because you had insured deposits and because you had so-called liquidity backstops, banking industry and the market did not require you to hold as much capital because there was a backstop. And that has become ever more the case. And if the only thing that now is keeping capital level is the Fed has put, and the regulators have put, a minimum leverage ratio in place. Without that, it would fall further because the risk-weighted capital would be gamed. So you have this long history of decline as the regulator and the bureaucracy has taken over the market and decides what is enough capital, and the lobbyists have lobbied to them and to Congress. You've seen the capital ratio come down. And one of the things I always enjoy watching is when you have a hearing and you have the senator or the congressman say, you know, you cannot require more capital of these banks, you're going to hurt borrowers. It is a very difficult thing to stay quiet about. Because we know that when the capital ratios are strong and the financial stability is greater, the cost of debt goes down. But because you have this backstop, that's no longer recognized. And so the bureaucracy allows it to go down. And now, if you go further than that, if you look at the largest banks, the lower line, the black line, is what's called the leverage ratio for the largest banks, the so-called GSIBs, globally systemically important banks. And they run, if you look at the end of the graph behind me and over here, they're now running about 6%. So they have the equivalent of 6% equity to their total liabilities plus their contract liabilities, and they're the systemically most important banks in the world. And they're the least well-capitalized banks in the world. The United States is 6%. Europe is a little under 5%, 4.8%. So these are highly leveraged and highly backstopped by the federal governments, our federal government in particular. So when you say too big to fail, it's genuine. These banks are too big to fail, and therefore they can hold this much. If they were on their own, I can assure you that the market would require more capital. You can see that in smaller banks. The regional banks and the community banks have anywhere between 9 and 10% leverage. That is equity to total assets. Now, we've learned recently that even they can't fail in the sense of their stockholders being wiped out, but they can't fail in the sense of their creditors being wiped out. And that's why they can still leverage themselves and operate and go forward. So my point is, we have this huge safety net. it's very costly to the American taxpayer because we are underwriting the leverage that's there. And when they say this will hurt the borrower, it will make it maybe 2 or 3 basis points more expensive in terms of research that's been done. And I would tell you that this is what's going on and what's going to go on forward. And in fact, the safety net's being increased always. And that's why I'll bring in my second topic. The Federal Reserve has, over the last 4 decades, precipitated 3 major crises. The crisis of the 80s, when they kept interest rates low through the 70s, and we had inflation and low interest rates through that entire period. And then finally, when Paul Volcker had to come in and whip inflation, if you will, break it down, we had a major banking crisis. S&Ls failed en masse, banks failed en masse. The largest banks had capital injections supported by the federal underwriting. And so we had a huge fallout. We had it again in the 2007-8 crisis, or the great financial crisis, where banks failed by the hundreds. And we had a period before that when interest rates were brought down to 1% and left there indefinitely. And then we had it again with Silicon Valley, and that was staunched early because they intervened aggressively and early. But the point of that was, when you have a long period of low interest rates, you end up creating instability. One of the things that was sold to the American people around the great financial crisis is macroprudential supervision will take care of that. Well, macroprudential supervision are strong capital standards, strong loan-to-value minimum requirements, but they're administered by the government. So the very institution, the Federal Reserve, who is introducing the instability by having low interest rates to boost the economy, are also the ones who are going to administer the capital requirements that would constrain the economy. And you can see why we don't have stronger capital rules in the so-called risk-weighted or leveraged systems, because they would constrain the growth in the economy, supposedly. But they create instability. So what happened following the Paul Volcker? You had massive failure. You had a major recession. What happened after the great period leading up to the great financial crisis, when interest rates were brought down to 1%? You had massive failures. You had a major recession. What would have happened following Silicon Valley if all those banks that had the runs would have been allowed to fail? We would have had a massive financial crisis again. So my point is, macroprudential doesn't solve the problem. The problem is you cannot take the market out of the picture and have market discipline. And we've taken the market out of the picture and lost market discipline. And now we are, I'm sorry to say, a country which is administered in terms of its economic activities. Much more government intervention. The boom we're having right now is supported by enormous amounts of subsidies that will go forward, and an environment where 5.25% used to be the normal interest rate. Now it's considered the tight interest rate, and they can hardly wait to cut. So I think there needs to be more market and more discipline brought to the economic system if we're going to have I think, continued growth in this economy. Otherwise, the deficit, which is now $34 trillion, will be the $50 trillion that's projected. The growth rate in the economy will slow, and we will have a poor U.S. economy in the decades ahead. The choice is ours to make now and in the future. So with that, I'm going to stop and turn it over to Tom Hogan, who will brighten your day. Thank you very much.
Switch my slides. Well, yeah, thank you everyone for joining us today. I'm happy so many people are so interested in financial regulation. I'm interested in it too, so I'm glad you guys are excited about it. We're happy to be talking about it. And yeah, thank you to Steve for inviting me and for having us out for this discussion. I'm going to talk, I think you can just play for the slideshow from the start. I have more slides than Tom Hoenig did, so I'm gonna be relying on those if they're available. All right. Yeah, so these are a little more important for me. So my talk, I've titled this Bank Regulators Indiscretion, which, is a terrible pun about the discretionary regulation. And I'm going to give 3 examples of this. I'm going to talk about bank capital rules, which is partly a recap of what Tom Hoenig has discussed here, and then 2 other examples from crypto and climate. What are the bank regulators doing being involved with climate? It's a bit of a surprise. So first of all, what do we mean by discretion? Discretion is defined in the dictionary as acting according to one's own judgment. So the regulators are making judgments here, right? They're not following rules. We're supposed to be a nation of rules, right? Not being governed by men, but being governed by rules. So why do the regulators have a lot of discretion in the rule-making process and in the enforcement of these rules? Shouldn't this be something that they're following rules, not just making decisions about this? So I'm going to talk about discretion in 2 areas. One is in the design of the regulations. And what I mean by that is mostly, do they do careful analysis? Do they do a cost-benefit analysis to decide whether the regulations are going to be good for the economy? Or do they just kind of make it up based on their own discretion? You can probably guess what my answer is to that. The second area is about the implementation and enforcement and how the Fed and the other bank regulators are using discretion in these areas as well. And so, discretion could be a good thing. If we thought that they were going to always do a good job, maybe the regulators are experts that always do a good job. But I think there are some problems with this. A normal one that we talk about in economics is the knowledge problem, that the regulators just don't know. They don't have all the information, and therefore we need transparency. We need the public to be able to see what they're doing so that we can give feedback, and it's not all discretion. But second, their incentives aren't always properly aligned, that sometimes they have political motivations or other motivations that cause them not to do the best thing. So these, of course, lead to bad economic outcomes. I'm not going to talk as much about the outcomes today as I am going to be just giving examples of the discretion that the regulators are using in the cases that I mentioned before. The first one being the risk-based capital ratio. So Tom Hoenig has already talked about this a little bit, just to recap a couple of the things that he said here. So, the risk-weighted capital ratio is when the regulators are going to rate all the different types of bank assets according to their level of risk, right? Assuming that the regulators know what the riskiness is of all these different asset types, right? And this, in theory, could be a good idea, right? It might be the case that if we're requiring banks to have some level of capital, that some banks are going to have a lot of risky assets and others are going to have safe assets. And the banks that have more risk, well, maybe we should require them to have more capital, right? That might make sense. In theory, that might make sense, but the way that it's implemented in practice, it's not very effective for a number of reasons. One is that it's very costly and inefficient, right? As Tom Hoenig mentioned, this is hundreds or thousands of pages of regulations that the banks are required to do. They're filling out all these forms. A lot of them are small banks that aren't involved in these risky areas anyway. So it's a big burden for them without very much benefit. So that's a problem. Another problem is that these risk-weighted ratios, they're not good measures of risk. If the regulators did know the riskiness of all the different assets the banks were holding, then yeah, maybe this would be a better measure and a better way to identify risk. but in the real world, it's just not. There are a number of studies about this now. At least a dozen studies showing that these risk-weighted measures are not better. And it's really not much of a surprise that as the measures get more and more complicated, they become less accurate. Like an analogy I make is to the tax code. The more complicated the tax code is, the easier it is for individuals or corporations to find some loophole and avoid their tax burden. Regulations are the same way. The more complicated it is, the easier it is for the big banks with armies of lawyers to find loopholes and avoid the regulatory burden. So it's no surprise that these measures are not better indicators of risk. Another problem is that they can actually cause banks to increase their risk. So the most common example of this is mortgage-backed securities. In the late 90s and early 2000s, regulators thought mortgage-backed securities were really safe. And so they told the banks, like, those are super safe. You should hold lots of those. That did not turn out well, right? Mortgage-backed securities were one of the major causes of the 2008 financial crisis. And so it's a bad idea for the regulators to be encouraging banks to hold these risky type of assets. Another point of that is that it actually increases systemic risk because it gives all the banks the same risk exposure. If everyone's holding mortgage-backed securities, then when there's a downturn in the market for mortgages or mortgage-backed securities, all the banks are going to be affected, right? Not like if they were all diversified and only a few are affected. If you have them all hold the same asset, it increases risk in the banking system, right? So all these are big problems with the risk-based capital system. They're all well documented, lots of papers about this. So you would think that the regulators would do very, very careful analysis to make sure that they're avoiding these risks, right? Right? Maybe not so much. So I did a study actually where I went back and I looked at all the regulatory proposals related to risk-weighted capital ratios and sometimes related liquidity ratios, and to check, see, did they do a quantitative cost-benefit analysis to make sure that these regulations are going to cause benefits rather than harm to the banking system? So here's a table which I know you guys cannot see, so I'll just tell you what's in it. So this is a list of 27 regulations that I identified that were related to risk-weighted capital. And I asked the question, first, did they do an impact analysis? Impact doesn't necessarily mean cost-benefit. It might just mean, are banks going to be required to raise their capital ratios? And I find that in 9, roughly a third of the cases, they did some kind of analysis. How many times did they actually say the benefits exceed the cost? It turns out 5 times they claimed that there would be net benefits. How many of those cases did they actually do a quantitative cost-benefit analysis? 0. Not a single time have they ever done a careful study to prove that the benefits of these regulations are going to exceed the costs, which, as we just talked about, the costs are high. So this is a case where they're not doing any analysis. They're just deciding based on their own discretionary judgment that these regulations are going to be a good idea. Let me give you a couple examples that are quotes from these regulations. So Basel II, when this was implemented in 2003, the proposed rule said, the anticipated benefits of the final rule are difficult to quantify in dollar terms. Difficult to quantify. So we don't know. We actually don't know how big the benefits are going to be. They also say the benefits of the rule are more qualitative than quantitative, right? So again, we don't know. We don't know what the benefits are going to be here. And yet, this is the OCC section. They say the OCC is confident that the anticipated benefits well exceed the anticipated costs. Wait, well exceed. You just said you didn't know how big they were. I mean, that doesn't make any sense, right? If you're comparing benefits and costs, you got to know how big are the benefits and how big are the costs. That's the only way that you can say the benefits are bigger than the costs. And yet, they're claiming here that the benefits well exceed the costs, even though they're admitting they don't know how big the benefits are. Right? This is clearly a case where they've just used their own discretion to just decide we think this is a good idea without having any evidence that this is actually going to be better for the economy. Here's another one from the standardized framework in 2012. The benefits of the NPR's notice of proposed rulemaking are more qualitative than quantitative. Again, we don't know how big they are. It's qualitative. We just have a feeling that this is a good idea, right? And yet it says improvements in the safety and soundness of the banking system would dramatically overshadow any cost borne. Dramatically, right? The benefits are way bigger, even though we don't actually know how big they are, right? Does that seem weird? And the fact that they think it's dramatically bigger means this is even more egregious, right? Because look, if the benefits are huge, it should be easy to do a study saying how big they are, right? Like if the costs are $1 and the benefits, even if they're variable, you're like, they're anywhere between 100 million and 100 billion, right? Okay, that's huge. It should be easy to do a study that shows how big that is, right? And so it's even more egregious if you're not doing that if you believe the benefits are big. Let me give you one more here. This is from the net stable funding ratio. This is the Fed, the notice of proposed rulemaking quoted a study from the Basel Committee on Banking Supervision. Net benefits can only be qualitatively conjectured. We can't possibly have any quantitative number, only qualitatively. And yet, the net social benefit is expected to be significantly positive. This is all made up, right? All of these cases where they've just said, we believe that the benefits exceed the costs, it's all made up. It's purely discretionary. It's not based on any evidence from the real world. That's a problem, because as we talked about, there were serious consequences in 2008 and continuing today from the recent bank failures. All right, the next topic I want to talk about is crypto regulation. So, you know, cryptocurrency is a new area that is very controversial still. For a while, for a few years, the regulators were in a kind of wait and see approach. They're waiting to see what Congress instructed them to do about crypto, whether they should be allowing it, how they should be treating it. And then about a year ago, last January, the Biden administration issued a report that strongly condemned crypto. And right after that, all the major bank and financial regulators went on the offensive. The SEC in particular started charging all these companies with, mostly with the facilitation of sale of unregistered securities. But the SEC refused to tell these companies which crypto tokens were securities and which ones were not. Like, how can you know if you're breaking the law if the SEC won't even tell you which tokens are securities? Like, you can't possibly figure that out. But this was purely at the SEC's discretion to sue all these companies without even telling them what the law is. That's a big problem. But I want to focus really more on the Fed and the bank regulations that are dealing with crypto. So there are two examples here. One is the holding of crypto assets, and the other one is the issue of stable coins. So one question is, can banks hold crypto on the behalf of their customers, right? Can they act as custodians? This should be, in theory, something the regulators really want. Because if we're afraid of people investing their money in crypto and potentially being scammed or not understanding how the technology works, then it's a good idea to have banks that are custodians of your assets hold those assets on your behalf, right? That's exactly what we should want. And if the bank is holding them as a custodian, then the bank itself is not taking any risk because you, the owner of the asset, are the one that is exposed to the risk. The bank is just holding it on your behalf. So this seems like an ideal way to allow individuals to invest in cryptocurrency. They can be held by a custodian, and yet the bank is not increasing their risk exposure at all. So should be ideal. Do you think the regulators like that? No, they do not, right? So the Fed has created some guidance, not regulations. The Fed didn't create an official rule. They didn't go through the rulemaking process of providing notice to the public and then getting feedback and then creating a final rule. Instead, they just issued discretionary guidance based on what they think is a good idea. So here's what that guidance says. Banking organizations are neither prohibited nor discouraged from providing banking services to customers of any specific asset type. Neither prohibited nor discouraged, right? Sounds like it's fine. Sounds like banks are allowed to do that, right? Except it also says the agency believes that issuing or holding as principal crypto assets is highly likely to be inconsistent with safe and sound banking practices. So it's totally legal, you can do it, but I wouldn't do it if I were you, Because if you do, you're going to be sanctioned by the Fed and the other financial regulators. And they have a bunch of soft power that they can cite you. They can prevent you from merging or purchasing other banks or growing or opening new branches. In some cases, even prevent you from paying dividends. Like all these ways that they can punish you if you're not doing the things that they say, or even the things that they say are legal but are not a good idea. This is strictly discretionary, right? Again, it's not a rule. It's just guidance that says it's legal, but I wouldn't do it if I were you, right? That seems like a problem. The Fed then, and I should say, this is also, I'm using this example of custody, but it's also a lot of other crypto-related activities and crypto exposures. So this same language is applied in a lot of ways. Okay, so then the Fed issues that guidance. But the thing is that the Fed is really in charge only of bank holding companies, right? And the OCC is in charge of national banks, and the FDIC is in charge of banks that have deposit insurance. The Fed is not supposed to have jurisdiction over state banks, but they do have some ways in which they can apply those regulations to state banks. And so what they did was they said, okay, so we know we're not in charge of state banks, but this regulation is going to apply anyway. They said the board has the discretionary authority under Section 913 of the Federal Reserve Act to limit the activities of any state bank, right? Discretionary authority. Wait, why do we even have this in the Federal Reserve Act that says the things that you are and are not allowed to do if you're just able to decide on your own what you are and are not allowed to do, right? That doesn't make any sense. You don't have total discretionary authority here, but they said they did. So, hey, I guess they must believe that, right? So they say, all right, here's what we're going to do. To level the playing field between the national banks and the state banks, we're going to apply these rules to the state banks, which basically says the board would presumptively prohibit state banks from holding crypto assets as principal. Wait a second, prohibit? You just said for the national banks that they could do it, but they just needed to be careful. Now for state banks, you're saying it's prohibited? How is that a level playing field? And why is the Fed able to discretionarily push this regulation down to the state level? Seems like a bit of a surprise. Maybe not a good idea, at least if we want to have a dual banking system like we have traditionally had in the United States. Okay, another example is stable coins. So stable coins in crypto is when you have a crypto token that is tied to the value of some other asset, most commonly the US dollar. So there are companies that issue these tokens and make them redeemable for US dollars. And those companies, of course, have to hold large volumes of US dollars and in some cases treasury assets in order U.S. treasuries as assets in order to redeem these stable coins, okay? So this seems like a decent idea that banks should be doing rather than some other risky company that's not registered. If you have a regulated bank doing this, then the Fed can be sure that that bank has enough reserves that they're able to redeem these stable coins. Seems like exactly what the Fed should want. Do you think they like that? No, they do not, right? So stable coins, the Fed says, and this is state, but this also applies to national banks. They say a state member bank seeking to issue a dollar token would be required to adhere to all the conditions OCC has placed on this activity, right? So you can do this, right? It sure sounds like you can do this. All you have to do is obey the rules, right? But the board believes that this would be likely to be inconsistent with safe and sound banking practices. So again, you can do it, but I wouldn't do it if I were you. This is the Fed using their discretionary authority to tell banks what and what not to do without creating an actual rule. Okay, the last area that I want to talk about is climate. So what is the Fed doing with climate? I mean, how is the Fed is the central bank. How are they involved with climate at all? Well, the argument is that look, there could be some climate event that creates a risk to the banking system, right? Banks, maybe they make loans to people that want to build a beach house and then the temperature goes up and ocean level rises and then all the beach houses collapse and the banks, then lose all their money, right? Okay, I don't know, maybe that could happen. They're implementing this in a couple of ways. One is still kind of preliminary. They're just testing this out. I think they have not rolled it out officially to large banks, but they're testing out with some large banks a climate stress test. So this again is like, it's some made up scenario where they're like, okay, the ocean level rise and all these beach houses fail. What is your exposure to beach houses or to whatever thing? Totally made up, no justification based on science that anything like this might even happen, but the Fed is just going to make up these scenarios and see how it affects bank assets and therefore, bank stability. So that's still in the process of being done. Another one that it was a rule that was created that has already been finalized is the framework for climate risk management. So this is a framework. Again, it's not a specific regulation that tells you exactly what you have to do. It's just a warning to banks that here are a bunch of risks. You need to be careful about them. And if you're not being careful enough to our satisfaction, we'll penalize you for that, right? So this again, they say these neither prohibit nor discourage financial institutions from providing certain banking services, right? And Jerome Powell has talked about this. He says, look, we're not trying to get too involved here. We have a limited authority. He says we have a narrow but important responsibilities regarding climate-related financial risks. We need to look out for the banking system, make sure that they're not taking too much risk here, right? And he specifically says, we will not be a climate policymaker, and we will not push to promote greener economy or pursue climate-related goals. Except that they are. The Federal Reserve has joined this international network of central banks that is the network for greening the financial system. Greening sure sounds like they are pushing a greener energy agenda, right? And in fact, if we look at this agency's website, it says that their goal is to meet the goals of the Paris Agreement to mobilize capital for green and low carbon investments. That is the goal of a group the Fed is a part of. So how can Jerome Powell say, yeah, we're not doing this for green energy? You're part of a group dedicated to bringing green energy, right? So one of those things is not true. If it's true that you're not trying to push a green energy agenda, you need to get out of this group. It also says on their website that their purpose is to mobilize mainstream finance to support the transition towards a sustainable economy. Again, this is the Fed being part of a group that is dedicated to green energy and opposed to fossil fuels. Right? So Powell can't claim that, hey, this is not part of our agenda, that we're not part of the green energy agenda. You're explicitly part of it. Okay, so let's look at what these rules actually say here. So one of them, they say bank management should assess whether climate-related financial risk could affect its liquidity position, and if so, incorporate these risks into their liquidity management practices, okay? So pretty vague here. Like, what do we mean by that? How are we supposed to know? There's no actual guidance or specifics about what they have to do here. It's just totally subjective. It's just totally discretionary whether the Fed thinks you've gone far enough in hedging your green energy risk, right? Here are the risks, some of the risks that they cite. Hurricanes, wildfires, flood. If you skip down to the end there, sea level rise and ocean acidification. Ocean acidification is a threat to bank solvency. Okay, so again, the oceans are just going to boil and all the beach houses are going to fail. Like, I don't know, it's weird. Like, how would you even model that as how do you know if you're exposed to this risk? The Fed does not say. They just say that you need to be doing something about it to protect yourself from that risk, right? How are these different from weathered? So floods, for example. Banks already have regulations about their exposure to floods. I mean, when I bought a house in Houston, it was in a floodplain. I was required to get flood insurance for my mortgage to protect the bank, right, against losses. If those regulations are not good enough, you need to change the current flood regulations rather than creating a whole new climate change flood regime. Like, how do you even tell whether it's a regular flood or a climate change flood? Like, what does that even mean? I don't know. The Fed doesn't say. They're just, telling you have to deal with it. And these are things that happen slowly over time. And so it's not like something that's going to happen tomorrow. They should have plenty of time to hedge these risks. It's very strange the way the Fed is talking about this. Okay. The last thing that I want to point out here is that they talk about this new category that they introduced called transitional risk. What is transitional risk, you might ask? Transitional risk refers to the stresses to certain institutions or sectors that arise from shifts in policy, consumer business sentiment, et cetera. So consumer business sentiment is like, okay, we're moving away maybe from fossil fuels towards green energy. So maybe banks need to be worried about their lending to fossil fuel companies and oil companies, okay? All right, I mean, again, that doesn't happen overnight, but maybe you want to worry about that. But changes in policy, this is like, well, in the future, Congress may say that, may put more regulations on fossil fuels and oil companies. So you, the banks, need to be preemptively lending less to fossil fuel companies and more to green energy companies. You need to reduce your fossil fuel risk now just because this might happen in the future. A law that's not even in place right now, the Fed can go ahead and start enforcing related regulations to that. So I think this is a big problem. I mean, it's all totally made up. It's all totally discretionary here. It's not what we would normally think of as regulators following a rule of law. I think it's not transparent. It's not fair and unbiased. It's undemocratic and basically un-American. Thanks very much.
We'll take some of the questions. Anyone have questions for our two speakers? Yeah. Go ahead, Frank.
Thank you. Excellent presentation. So if the private banks, if the capital, level of capital security is an issue, if it's dangerous for the banks not to have enough capital, why don't they take those measures themselves instead of, allowing themselves to be over-leveraged?
If there were a market, they would. But if you're running the bank, one of the things that you focus on is your ROE, return on equity. And so if you can lever up more and you can put more risk in the bank, and you're pretty confident that you will be supported, you won't have the big run that you would otherwise have, you're going to lever up. And then when you base the capital system on encouraging certain leverage in certain areas, the incentives are such that you lever up even more. And for example, if I don't have to have any capital against market risk, and I know that the Fed's going to provide all the liquidity in the world, if should there be a problem, you lever up. I mean, you can basically use your deposits that you pay 1.2% on in today's world, and even leave it at the Fed, or you can buy government securities on the longer end. You might do that, especially if the Fed is saying to you, I'm not even thinking about raising interest rates. So you get all these distorted incentives that encourage you to lever up. Now, if you were in a situation where you would be allowed to fail, and you knew you were going to be allowed to fail, and your creditors knew you were going to be allowed to fail, then you would have 50%, 40% capital. And then I'm going to turn over to Tom, but there's a new book out it's a new edition of the book, Banker's New Clothes by Anat Ahmadi and Martin Hellwig. Hellwig's from Europe, and they go through this very systematically. And it is just mind-boggling what we've allowed. And I don't blame the bank, just so you know, because if you give me an incentive, I'll react to the incentive, and that's what we've done. So. This is a very political issue, primarily a political issue. It's just a nonsense issue. But, I'll give you an example. So the Fed joins this international group, and then about, 3 months ago, they put out an announcement that they're not going to incorporate the BIS, which is the Bank for International Settlements, international groups, new risk-weighted system. They're backing away from that because now that's become, because of some of the responses they got, that's very unpopular to do that. So it's a political And so we don't know where it's going to end up. It's so out of control. And that's really hurts the banking industry, hurts the consumer. But in the name of we're going to make sure green energy takes over is where we're coming from with this. And it's just chaos.
Thank you. I'm just kind of curious from a political point of view, where would someone like an Elizabeth Warren stand? Is she behind the RBC, or would she be demanding, she always seemed to like she'd be demanding more real equity from the banks?
Yes, she would. She would. However, she would, well, no one understands a risk-weighted capital measure, but she does know the industry needs more capital. So now I will tell you something, she did this in public, so everything is political. And while she will say that in some cases, for her banks in New England, maybe not so much. So, it is, but the thing about it is she will not say, let the market decide. And when you have a crisis, she will not say, let the bank fail, because that's just not a very popular thing to do in a crisis. You have to have it pretty much in the culture of the economy, which we've long left.
Okay, any other? Good.
So I don't know Elizabeth Warren's perspective on that in particular, but there certainly are some areas where we're critical of the regulatory system, and she would be in agreement with that. I can think of one that I think after Dodd-Frank, she did a talk at the Cato Institute when they were talking about reforming the last resort lending facility at the Fed, because there was an agreement that the Fed had gone too far bailing out the big banks. And so, yeah, there's potentially room for that for people of critical on both sides of the aisle of areas where, the Fed or regulators have gone too far.
Can I add one? Different topic, but there's a new proposal out to begin to backstop more and more of the mortgage-backed servicing and so forth. And some in the but that's an extension of the safety net, and so there is in both parties concern about continuing to broaden this safety net and the cost to the taxpayer. So there is some realization of that, but it's still pretty sparse. There's a question in the back there.
Any other questions?
I hate to ask two relatively brief questions, but do you happen to know, first of all, what the penalization for a bank that is not following safe and sound banking practices would be, and how would be the way that the Fed would adjudicate those?
Well, yes. Let's say you're a bank and you're trying to do one of these things, and the first thing is the examiners will come in and examine you, and they will judge the quality of your assets based on underwriting standards and so forth. And then they will look at your capital, and they will look at your banking practices and your management. And let's say that they say we're nothing wrong with this except it's not very safe and sound. So they then kind of systematically say this is you have these assets on your books, they're not safe and sound, we'll write that into the exam report. And if you have a lot of it and you haven't changed, then, and they come to the conclusion that it is not safe and sound, they can issue you they can request a board resolution. So they will go to your board of directors and say, this isn't safe, give us a plan to get out of that or to make it more safe and more sound. If they're not satisfied with that, they can go to a memo of understanding where they set out a series of conditions on the bank directors and management of things they will do. We want a better capital plan because you have these risky assets. Or we want you to reduce the concentrations in that area because it's risky. So they can do that. If you start having losses, so if somewhere in your bank you have losses, they can issue a cease and desist order on you, which is, a written agreement or a cease and desist, which is enforceable under the law, if you sign it, if your board signs it. If they say, no, we're not signing that, it's not safe, it is safe and sound, then you can have a hearing, and you go before a hearing judge. And so you go through, it's a very expensive process before you're done. So you can be, I'll call, nagged to death in getting yourself in line. So you want to add to that?
Okay, I think we have time for one or two more questions from anyone. Have other questions? Yeah.
Just a quick separate question. What was the name of the international organization that the Fed joined?
The Bank for International Settlements. Oh, no, the one that they joined. You want to?
Yeah, it's the Network for Greening the Financial System. I think that's what it's called. Feel free to send me an email if you need more information about it.
Thank you. And Europe has a big role in that. It was started in Europe, and Europe is very intense on this. And I will tell you, the U.S. uses that as a justification for themselves. Those within the authorities who want to go that direction use Europe as their prop for, yes, we have to join this group. So.
Any other questions? Any more questions?
Yeah, I think Mr. Hoenig said that we need to introduce more.
Hold on, Jeff.
I think you said we need to introduce more free market into
More market.
the risk evaluation system.
Well, yes.
How to do that?
Well, here's what I say to people. And I'm not hopeful, so don't misunderstand me. But the rules need to be simple, understandable, and enforceable. So we know that if you didn't, if you were clear, if the law said you cannot bail out banks, all right, and it was enforceable, banks would, on their own, hold more capital, number one. Number two, if you say, if you're going to have a rule of capital and you say, historically it's been leverage ratio at this percent, but, and in fact, one of the congressmen once said, if you will get your capital ratios up above 10%, then the trade-off would be you would be exempt from Dodd-Frank. You know, I mean, 2,500 pages of law and about 25,000 pages of rules. But no one's going to do that. So you have to say, we trust the market, and we are willing to pay the penalty if the market gets out of control. And I think we're a long ways from that.
Okay, any other questions? If not, we will wrap it up. And thanks to our two great speakers.